Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This podcast was recorded for publication on the 6th of June 2025 by HSBC Global Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And remember to like and subscribe to the Macro Brief wherever you get your podcasts.
Hello, I'm Piers Butler, and this is the Macro Brief, where we look at the issues driving financial markets across the globe. And this week, I have a special guest with me in the studio. All the way from Sydney, I'm joined by Paul Bloxham, Chief Economist for Australia, New Zealand and Global Commodities. And it's that last part of Paul's title that we are talking about today, commodities. Commodity prices have been firmly in the spotlight recently, and tariff uncertainties and global growth worries have only sharpened the focus. Paul, I know you have a busy schedule meeting clients, so thanks very much for talking to me, and welcome to the Macro Brief, or should I say, good day?
Yes, it's great to be here, and yes, you should say good day.
So you published your Global Commodities Review back in March, and you were already flagging the impact of Trump's trade policies. We then had Liberation Day, pauses, more announcements, more pauses. It's hard to keep track. Where do we stand today, and what has the impact been on commodity prices over that period?
Yeah, you're right. So Trump, tariffs and trade, that's what we called it. And that's because, of course, we thought that was front and center in terms of what it was going to mean for both global growth and, of course, the commodities outlook as well. And I think, we've gotten a lot of the results that we expected. We've seen commodity prices come down since Liberation Day. Not as much, perhaps, as in an aggregate sense as people had been expected. They're down 4% for what it's worth from the 2nd of April. But the thing is, underneath that, there's a compositional story where you've seen metals prices come down, you've seen oil prices and energy prices generally come down by more. But of course, you've got gold prices that have gone up. So in that aggregate index, there's quite a lot of divergence. But I would say, in broad terms, the effect of this in terms of increasing uncertainty and creating downside risk to the global growth story is the main feature of what's driving commodity prices to come down, and that's what we had anticipated.
And so you've more recently published Commodity Price Snapshot, and in that you identified 3 economic effects of this trade uncertainty. Can you break it down for us?
Yeah, so I think one way I approach this is, as an economist at least, is to try and say the things that you think you know. Whereas, we don't know what's going to happen every day and what the Trump administration is going to deliver. It's very volatile. But I think there are 3 key things. Firstly, there's been an uncertainty shock delivered to the global economy from basically the 2nd of April onwards. But since then, and uncertainty is still very, very high. And uncertainty is bad for growth. It makes it difficult for businesses to make decisions about hiring and investment, and it weakens growth. So I think that shock's already been delivered. Secondly, we haven't seen it show up in all the economic indicators yet because there's been massive front loading. Businesses have been getting ahead of the expected arrival of these tariffs by importing more, and on the other side of that, you've got exporters out of Asia in particular, and they've been producing more, and consumers too, I think, have been front loading their spending ahead of the expectation of tariffs rising and prices increasing. And then, so if you put those 2 things together, I think you're going to get a rollover, you're going to get a decent slowdown in growth in the second half of this year from those 2 factors. And wherever we land, the third one that we sort of work with is tariff rates into the US are going to be higher than they were prior to the 2nd of April. The question of how high is the one that's hard to know and hard to answer, but that's going to be disruptive for global activity. So I think you add all that together, it's downside risk for global growth, and that, in our view, is downside risk for most of the commodities, not gold, but most of the commodities.
Talking about most of the commodities, in your experience, do they lead or lag? I mean, what kind of signal are they giving you? I mean, we saw the OECD revising down their estimate for global growth.
Look, my experience is that mostly these are fairly contemporaneous indicators of what's going on. For years we've described, it's typically described that copper is a good signal of what's going on in the global economy, and they refer to something called Dr. Copper. It's telling you how the global economy is likely to travel. It's such an integral commodity in all sorts of products that's been this sort of cyclical indicator. But it's not so much that you look at it to say, hey, this is giving you a lead necessarily. It's to say say, this is what's going on right now, right? And so I think that's what we think commodity prices largely do. They're sort of largely contemporaneous rather than something that's giving you a really solid lead on what's going on. Copper, I think recently, for what it's worth, is breaking down in terms of being that useful indicator that it was. And to me, the primary story here is the energy transition. So you've got this big structural story that's sort of meaning that the copper price doesn't necessarily track the activity as easily. It's more driven by this sort of fundamental change in what we need, the products we're needing, and the materials we're needing to make them.
Talking about traditional indicators, is gold a traditional indicator of uncertainty? I mean, it certainly seems to be, doesn't it?
Absolutely. So, and I think this explains why we are where we are right now. Gold prices have been, getting to all-time highs, and I think that's a high reflection of all the uncertainty that's coming out of the Trump policy changes. But I think also, so it is an uncertainty story, but it's also, in this question that's being asked about whether the US dollar is going to weaken further and how much investors should hold in US government bonds because maybe they're not quite as risk-free as they were. Well, you're looking for alternatives, and gold is one of those alternatives. And so I think that's what we're seeing in terms of what's been pushing the gold price to these high levels.
And we've seen central banks in particular buying.
So central banks are buying gold, but it does extend beyond that. It's global investors wanting to hold more gold, and that's putting upward pressure. And I think, to your point, it's absolutely a reflection of a highly uncertain environment, and I guess a shift in the way global investors perceive risk and where the risks are, and perhaps less willingness to want to hold US sovereign assets.
Coming back to your global commodities outlook, one of the themes, you had 10 themes in there, we're not going to go through all of them, but one of the themes I was intrigued about was that you identify increased commodity market fragmentation. What's that in plain English?
Yeah, in plain English, it's that we like to sort of think that there's one price for any product, but there isn't always. And sometimes there's a price in one market and a different price in another. And for example, the copper price at the moment is a lot higher in the US than it is outside the US. And that's partly reflecting that in anticipation of tariffs that might arrive, there's been this big move of copper into the US market. And so that market has become fragmented. You can the gap between the sort of onshore price in the US versus the other price is much, much larger than it's normally been. And you're seeing that fragmentation across other markets as well. So for steel prices, for aluminium as well. And so, that's what we mean by fragmentation. You can take it one step further. There's quite a lot of commodities that aren't exchange traded, right, and aren't in deep liquid markets. And of course, those markets are often quite fragmented. But that fragmentation has risen because of the sorts of things that are being delivered by the Trump administration.
One of the commodities or set of commodities that isn't exchange traded is critical minerals and rare earths. And there's been a lot of headlines about that. How should we think about those?
Well, the first thing I would say is this, and there's this sort of, critical minerals, if you look at the US definition of it, and they've launched an investigation into it, is this really, really long list of different commodities. And so it actually almost covers the whole basket. That's so that's what the way they've been describing it. But within that, of course, what you're really getting at, I think, is rare earths. Now, rare earths are a very, very specific type of commodity.
And it's low. We're talking about low volumes, aren't they?
They're very low volumes. I think the globally traded amount of rare earths is less than 1% of globally traded oil, for example. So it's like a small category, but it's a small category that's super important, right? These rare earths are used for producing magnets. They go into electronics. They go into military hardware. There's this whole long list of 17 obscure rare earths that are part of the story. And so, I guess the size of that market in terms of what's traded by value doesn't really reflect their importance. They are, if you haven't got them, it's not going to be possible to produce some of the things that we do, electronics that go into, including phones and so on, but also the magnets in military hardware and so on. So they're really important, and they're becoming, of course, a trade negotiation tool, and that's the main thing. They are largely produced in China.
But do you think that the situation where people are worried about the supply from China, demand will discover more rare earths elsewhere? I mean, it's often the case with mining.
It's not something that's easily substitutable quickly. That's the answer. Over time you can start to shift things, but it's not easily substitutable quickly. So it is actually a genuinely useful tool in a trade negotiation setting.
An important one. Finally, we should talk about agricultural commodities. Cocoa beans, I looked at your chart, are up. Palm oil has collapsed. What's going on?
There's a lot of really interesting things in all the agricultural commodities, but I mean, the two you picked out, I mean, so cocoa has been actually at extraordinarily high levels. I think I looked at the numbers just before this, and they're 300% higher than they were in their pre-pandemic average.
Wow.
And so very, very high. And you're seeing it reflected in chocolate prices as well, because that's where this product is used. And that reflects that there, has been very inclement weather in what is a very sort of narrow geographically, sort of exposed area. So it's West Africa, and the vast majority of the global production is just in that particular area. So it's weather-related effects that have constrained supply. And I mean, this is the story about commodities in general. You can talk about big demand factors, but the primary thing is often sort of individual idiosyncratic supply disruptions. And so that's happened for cocoa, and they're at high levels. You could say something similar for coffee, which has been at high levels. Orange juice, although those prices have started to come down recently because there was quite sort of extreme weather that was disrupting supply. We were talking about the fact that olive oil prices have been very high because you had very dry conditions in Portugal and Spain in recent times, and that's damaged crops as well. Palm oil is, I guess, the other end of the spectrum, where you've had pretty decent supply. It's mostly produced in Malaysia, and they've got inventories that are climbing quite quickly, and that's put downward pressure on palm oil prices recently. So, yeah, in the ag commodity space, there's all these divergent supply stories, and they're often driven by weather. Geographical concentration is important as well. And I think the main thing we've been pointing out is, that combination is going to become even more problematic as the climate continues to change.
Yeah. So it's a real clear evidence that climate change is having an impact.
Yeah, and the fact that we are, where the climate change can have sometimes its most distinct effect is where you're highly reliant on a particular region that produces a particular thing globally, and the whole supply chain is sort of tied to that. You disrupt that, and suddenly, well, you've got a problem, but you can't fix it quickly. I mean, to your point about rare earths, but it's a sort of similar narrative. But for agricultural commodities, it really is a story for a lot of these sort of types of
I think I'll be stocking up on chocolate bars. Finally, and before you go, and I know you took time out from your busy marketing schedule to come and talk to us in the studio, but how's it going? What are clients asking you? What are they worried about?
They're watching what the Trump administration is delivering. I think one of the really big themes is the question around about the US dollar and where to diversify out of it to the extent that that's the story, how much the US dollar might weaken. What happens if we do go into a global downturn? Do the normal correlations where, typically a global downturn drives money back into the US dollar, drives it back into US government bonds, does that play out in the same sort of way? And I guess then what does that mean for everyone else? Like, what does it mean for EM, and what does it mean for the EM story? What does it mean for commodity markets that and commodity producers and so on? So I think that's been a big part of the conversation that I've been having with clients over the past week up here in Europe.
Do you think they've become a bit more used to all this trade disruption? There is a sense a little bit at the moment in the market there's been so much that everybody's become sort of almost desensitized to it.
Well, I would warn against that. I mean, I think that's the point that I'm making, is that we've become a bit desensitized because it's, as you say, sort of chop and change here and there, but there are some really big picture things we can step back and say. We can say uncertainty is high, and that's bad for growth. We can say the growth hasn't fully showed, the indicators haven't fully showed that downturn yet, and that's partly this front-loading effect. And so we can say once those two things unwind, you're still going to be in an uncertain environment. That's going to weaken growth. So I would ward against being, sort of being too sanguine about the risks here.
Well noted. I think that's all we've got time for today. Paul, thanks again for coming in.
Thank you.
Elsewhere in research, we've published the latest edition of Talking Points, our monthly look at the key reports covering our 9 key investment themes. Included this time are pieces on China's pension reform, the latest developments around US tariffs, plus looks at artificial intelligence, clean tech, and the net zero transition. Korea has ended a period of domestic political turmoil with the election of a new president. For more on that, listen to our sister podcast, Under the Banyan Tree, where economist Jin Choi and strategist Prerna Garg discuss the implications of the result for Korea's economy and markets. And finally, remember that HSBC clients can keep up to date with our latest research by downloading our app from Apple's App Store or Google Play. And if you have any questions or comments about anything we've talked about today, you can email us at askresearch@hsbc.com. So that's it for this week's Macro Brief. If you've enjoyed today's podcast, then please like and subscribe and share it with friends and colleagues. Thanks very much for listening, and we'll be back next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.